Hey everyone, welcome back to the channel. And I have a very special co-host joining me today, my daughter and a teenage stock market enthusiast in her own right, Ivana from Investing with EG. So Ivana, welcome to the channel.
Hi, everybody.
So in today's world, you literally can't open the news without seeing the word AI somewhere. It's everywhere. And while everyone is already familiar with the usual suspects like WU, QQQM, and the classic index funds, today we want to focus on three ETFs that are heavily focused on the AI sector. So if you're looking for some diversification in your portfolio for 2026, you're going to wait to pay close attention to these three. And we'll break down each one of them section by section, what's inside them, how they performed, what the risks are, and who each one is actually for.
Let's get into it.
All right, ETF number one is SMH, the VanEck Semiconductor ETF. And I want to start with this one just because of the sheer scale of this thing, because it sets the tone. $63 billion in assets under management, and this is not a niche fund. This is a serious institutional grade vehicle focused on the semiconductor industry.
And what I love about SMH is the focus. This isn't a broad tech fund trying to be everything to everyone. It tracks the 25 largest semiconductor companies listed in the US. Pure chips, pure silicon. If something powers the AI compute layer, it's probably in here.
Let's talk about holdings because that's where it gets really interesting. Nvidia is the top position in this fund at about 18.2%, which honestly is almost an understatement given what Nvidia has become over the last few years.
Nvidia is basically the operating system of the AI era at this point. Every major AI model, whether it's OpenAI, Google, Anthropic, it all runs on Nvidia. So having that as your anchor holding makes a lot of sense.
Yes, and then you've got Taiwan Semiconductor, TSMC, at 10.6%. And this is one I believe is underappreciated by a lot of retail investors because TSMC doesn't design those chips, they make the chips. For Nvidia, for Apple, for AMD, they're the factory floor of the entire semiconductor world.
Broadcom at 7%, Micron at 7%, Lam Research at about 5.9%, rounding out the top five. And I think it's worth pointing out, Micron showing up here and also in our second ETF later isn't a coincidence. Memory is becoming the critical constraint in AI infrastructure, and we'll get into that.
But the thing I want to flag about SMH is the concentration. The top 10 holdings are almost 75% of the fund. So if you're buying into this, you need to be comfortable with that. You're not getting the broad diversification, you're getting a very focused bet on the semiconductor sector.
Which is completely fine if you understand what you own. And I think the performance justifies the conviction. SMH is over 54% year to date in 2026. The 3-year return is about 92%. This is not a fund that has been sitting quietly.
The expense ratio is 0.35%, which for a specialized fund like this is pretty low. You're paying $35 a year on every $10,000 invested, which is fairly reasonable.
And it's been around since the year 2000, so it's navigated the dot-com crash, the financial crisis, the 2022 tech sell-off, and it's still here bigger than ever. That long track record matters a lot when you're evaluating whether a fund is the real deal or not.
So the bottom line on SMH is that if you believe the AI infrastructure build out is real and it's going to keep running, the semiconductor companies are where the money has to go first. So SMH is the cleanest way to own that thesis.
I totally agree. That's our number one. Let's move to number two. And this one is pretty well. Now we're going to be talking about DRAM. You can call it DRAM if you like. The Roundhill Memory ETF. Launched on April 2nd, 2026, as in less than 2 months ago. And I want to leave with the number that literally stopped me in my tracks when I first came across it.
Let's hear it.
$5 billion in assets in just 25 trading days. 10 trading days to hit $1 billion. That is one of the fastest ETF ramp-ups in recorded history.
At that number tells you something important, that it's not regular retail investors putting in $100 here and there. This is institutional money sprinting towards the thesis, which means that we should probably understand what that thesis actually is.
So here's the thing. When most people think about AI, they think about compute, the GPUs doing the math, the NVIDIA story, and that is real. But there's a second bottleneck that has been flying completely under the radar, and that is memory bandwidth. Every AI model needs to move absolutely massive amounts of data in and out of memory at incredible speeds. That is what high bandwidth memory, or HBM, does.
And the key insight here is that the HBM supply is generally constrained right now. Micron's entire 2026 HBM production is already sold out, and the big hyperscalers like your Googles and Microsofts are already prepaying in advance just to secure their allocation. And obviously, that's not normal market behavior.
When your customers are prepaying just to get on a wait list, you're not in a commodity cycle anymore. You're in a supply squeeze with a structural demand. That is a completely different kind of investment situation.
So next, let's talk about what DRAM actually holds, because this is where we want to be really honest about the risk profile. So it has 9 holdings in total, Samsung at 25%, SK Hynix at 24%, and Micron at 24%. Those 3 companies alone make up 73% of the entire fund.
It is concentrated, there's no sugarcoating that. But I would argue that the concentration is exactly the point. This is a high conviction bet on exactly the 3 companies that control the global memory market. You are not getting diluted by companies that have nothing to do with HBM or the AI memory story.
And let's talk about performance. The performance since launch is just extraordinary, up 107% in just about 6 weeks. And that also means that easy money probably has been made in the short term, and we certainly want to be honest about that.
And I think that is the honest conversation to have. If you're watching this thinking that you want to jump in for a quick double, that ship has sailed. But the structural story, HBM4 technology coming, CPU makers bundling more DRAM into their AI chips, AI models needing 10 times more memory bandwidth per GPU generation. That is a multi-year thesis that is still in the early innings.
Also, let's talk about the expense ratio. The expense ratio on this ETF is about 0.65%, higher than SMH, but for a fund this specialized and this new, this is in line with what you would expect for a thematic ETF.
And the way I think about sizing this one, it should not be your entire position. But if you believe in the memory supercycle story, having a meaningful slice of DRAM as part of a broader AI portfolio makes a lot of sense.
Now, as far as the risk goes, the risk that I see coming back is the cyclicity of the memory as a sector. Memory has been historically one of the most volatile parts of tech. If AI spending softens or the hyperscalers start working through their inventory, prices can correct hard and fast. So eyes wide open on this one.
Totally. High conviction, right-sized position. That is how we think about DRAM.
All right, number 3, and this is personally the one I find most interesting for the long term and patient investors. So this ETF is AIQ, the Global X Artificial Intelligence and Technology ETF. And I want to start with something that I genuinely think separates this one from the other 2. Now, this has been around since 2018. It has a real multi-year track record that has been tested across a variety of market environments.
And the numbers are legitimately impressive. 49% total return over the past year, 23.6% year to date in 2026. And since inception, going all the way back to 2018, the average annualized return is 19.57%. That is the kind of compounding that actually changes your financial picture over a decade if you stay patient with it.
Now, what I find most interesting about AIQ is the breadth. 92 holdings, and if we compare that to SMH's 26 and DRAM's 9, you're getting the entire AI value chain in just one single fund here.
And I think entire value chain is worth unpacking because it's more than just chip companies. The top 5 are SK Hynix, Micron, Intel, Samsung, AMD. So yes, hardware heavy at the top. But then you scroll down and you see Netflix, Amazon, Cisco, and Apple.
Which at first glance seems a little weird. Netflix in an AI ETF?
Right. And I had the exact same reaction when I first looked at the holdings. But Netflix's entire personalization engine, their content recommendation system, their production budgeting decisions, all of that is AI driven. The index that AIQ tracks has actual criteria for inclusion. Companies have to derive meaningful revenue from either developing AI or being fundamentally powered by it. And that distinction really matters when you're doing your research. AIQ has specific inclusion criteria and it shows in the composition of the fund.
Also for AIQ, the sector breakdown is really interesting too, with 64% going to information technology, 13% communication services, 10% consumer discretionary, and then a meaningful slice of healthcare and industrials where AI is generally starting to do real work.
And it's genuinely global, which is a big differentiator. About 55% US companies, but then South Korea at around 13%. That is your Samsung and SK Hynix, Taiwan at about 10%, and then Japan and Europe rounding out the rest. You're getting the full global AI supply chain in one fund.
And that's right, which is exactly something that you do not get from a US only fund. And I think that is underrated. The AI build out here is just not an American story. The companies that are actually manufacturing the hardware that powers AI are in Korea and Taiwan, and AIQ gives you that exposure.
or assets under management is 9.6 billion, so that it's liquid and well established. Expense ratio at 0.68%, the highest of the three we are covering today, but honestly not unreasonable for what you're getting.
That's right. And the way I frame AIQ relative to the other two is that if SMH is your high conviction focus bet, and if DRAM is your aggressive thematic play, AIQ is the one that you can hold without losing any sleep at night. It is well diversified enough that no single company is going to crater the whole fund, but it is also focused enough that you're genuinely participating in the whole AI growth story.
It's the I believe in AI, but I don't want to pick individual winners fund. And given how hard it is to predict who the long-term winners of any major tech wave are going to be, remember, back in 2010, nobody could have told you exactly which companies would dominate cloud computing. That diversified approach has a lot of intellectual honesty to it. Hopefully, these three ETFs give you a few more tools to answer that question for yourself.
So, which one of these three ETFs resonates the most with you? Are you already holding any of them in your current portfolio? I'd love to hear your feedback in the comments below.
And if this video is useful, please hit like. It actually helps more people discover both of our channels, which means we can keep making content like this. And make sure you subscribe if you haven't already so you don't miss the next one.
And while you're at it, also check out Ivana's channel, Investing with EG. The link is in the description below. She's doing some fantastic work over there. And I may be a little biased, but I'm happy to be biased. But I certainly think you all should go check out her channel.
I hope to see you guys all over there too.
We'll see you in the next video.
Thanks for listening.